Good evening, guys. So we are going to start the second session of advanced taxation, practice to pass webinar session. So yesterday we discussed about inheritance tax, and today, as I mentioned previously, we are going to discuss about capital gains tax. So here. There are several documents that have been uploaded to your handout section. First of all, I believe that you can hear me well, and in a while I will be able to share my screen. So anyway, you can download the documents from the handout section. All those documents are with regard to capital gains tax. And some of the technical articles written by your examiner is also available for you to get an understanding what type of questions that can be given at the exam and the areas that you should focus when you're spending time in your studies. So as I discussed yesterday, I told you you get questions from capital gains tax along with inheritance tax. So most of the time at the exam, you'll be given questions where you will be required to explain, the capital tax implications. So at the exam, if you have been asked to explain the capital tax implications, you need to remember you have to explain both inheritance tax and CGT implications. So yesterday they discussed some of the main principles with regard to inheritance tax. Likewise, today I'm going to discuss about some important aspects with regard to capital gains tax. So let me now share the screen with you guys. Okay, right. Now, you should have the ability to make a comparison between inheritance tax and CGT. Now, as we discussed yesterday, inheritance tax is applicable on gifts made during lifetime transfers and transfers made on death. But capital gains tax is little different from that situation because this is a situation where we have disposed certain assets. Now, on the inheritance tax, we learned for the purpose of IHT, there's nothing called exempt assets. But for the purpose of capital gains tax, you need to remember not every asset is subject to CGT. Accordingly, there are certain assets which are exempt from CGT. There are certain assets exempt from CGT. And at the same time, not every disposal is subject to capital gains tax. Now, there are different ways that you can dispose an asset. The main way that you can dispose an asset is by sale of an asset. You can sell the asset. So that's a way of disposing an asset. That's a way of transferring the ownership from one person to another person. Even if you gift an asset, that is also treated as a disposal. So there, the only difference is you don't receive cash, but you gift an asset. Now that is what happened on the inheritance tax. You gift the asset. But remember, the gifting of an asset can be subject to both inheritance tax and capital gains tax at the same time. So I'll come to that in a while. So gifting of an asset is also disposal. Even if an asset is destroyed or stolen, that is also a disposal for the purpose of CGT. But remember, there are certain types of disposals which are exempt from CGT. There are certain types of disposals which are exempt from CGT. Now, what are those disposals which are exempt from CGT? It's always better to memorize the disposals which are exempt from CGT, because the rest of the disposals are chargeable. So what are the disposals which are exempt from CGT? If you transfer something on your death, it is exempt from capital gains tax. That means when a person dies, if he leaves everything, if he distributes his wealth among his descendants according to a last will or even without a last will, that will be subject to inheritance tax, but it will not be subject to CGT. And on the other hand, if you make a gift to a charity, that is also completely exempt from CGT. Now we know gifts to charities also exempt from inheritance tax. Likewise, there are two types of disposals. If there are gifts made on the death of a person, then they are completely exempt from CGT. And if you make a gift to a charity, that is also completely exempt from CGT. And as I mentioned, there are certain assets which are completely exempt from capital gains tax. Now, it's always better to memorize and remember the type of assets which are exempt from CGT. Now, if you sell a car, any type of car, it's always exempt from CGT. And then current assets such as inventory, trade receivable, then cash in hand, cash at bank. So any type of current asset is also exempt from CGT. And then chattels. It's an important concept under CGT. A chattel is a movable tangible. The definition for a chattel is it's a movable tangible. There are two types of chattels. One is wasting chattels, the other one is non-wasting chattels. Now, if the lifespan of a chattel is limited to 50 years or less, we call it wasting chattels. If the lifespan of the chattel is more than 50 years, we call it a non-wasting chattel. It's always better to remember some of the examples that you get under wasting chattels. Now, if you take plant and machinery, they are deemed wasting chattels. A goat, a wasting chattel. A greyhound, an animal used for the purpose of hunting. A racehorse. Now, those are wasting chattels. Then on the other hand, we have non-wasting chattels such as antiques, jewelry. Now, those are non-wasting chattels. Now, if you take a wasting chattel, the general rule is normally they are exempt from CGT. Normally, wasting chattels are exempt from CGT except for plant and machinery sold at a profit. Plant and machinery sold at a profit. So normally, if it is a wasting chattel, it is exempt from CGT except for plant and machinery sold at a profit. If you have sold plant and machinery at a loss, that loss is not an allowable loss because a relief has already been given under normal capital allowance computation. Focus and remember these things, then you can get a better understanding. So wasting chattels are normally exempt from CGT, except for plant and machinery sold at a profit. They are normally chargeable for the purpose of CGT. But what if you sell your plant and machinery at a loss? That loss is not an allowable loss for the purpose of CGT because for that loss you have already been given a relief under capital allowance computation. Then when it comes to non-wasting chattels, normally they are chargeable for the purpose of CGT. Non-wasting chattels are normally not exempt from CGT. They are chargeable assets for the purpose of CGT. However, wasting or non-wasting, if you have bought and sold them for £6,000 or less, we call it £6,000 rule. Even if it is a non-wasting chattel, if you have bought it and sold it for £6,000 or less, then they are exempt from CGT. Non-wasting chattels are normally chargeable for the purpose of CGT, but if you have bought and also sold for £6,000 or less, then it's completely exempt from CGT. Then cash, as I said, current assets are exempt from CGT. Then we have something called qualifying corporate bonds, QCBs. Now, qualifying corporate bonds are normally loan notes, debentures issued by a company. So if an individual owns qualifying corporate bonds, or they have purchased debentures from a company, when you sell them, the gain will be exempt from CGT. Then assets held in individual savings accounts, exempt from CGT. Other current assets such as trading inventory, receivable, exempt from CGT. And then we have something called venture capital trusts. Venture capital trusts. There are different types of investment schemes available to an individual. You can invest in EIS shares. Then there's something called SEIS shares. Now, when you sell those shares, normally they are chargeable for the purpose of CGT. Then there's another way an individual can invest in unquoted shares. We call them venture capital trust. So if you have bought shares from a venture capital trust, if you sell them, then the gain will be exempt from CGT. And then there is something called endowment mortgages, endowment policy proceeds. They are also exempt from CGT. So remember a few of these examples, and it is better and advisable for you to be familiar with these examples. Then whenever you are given a question at the exam, you know whether to calculate CGT or just to ignore simply because they are exempt from CGT. Then the other aspect is not every person is subject to CGT. Not every asset is subject to CGT. There are exempt assets. And not every disposal is subject to CGT because there are exempt disposals from CGT. So when it comes to chargeable persons, not every person will be subject to CGT. Normally, non-UK residents non-UK resident individuals are not subject to capital gains tax. Only individuals who are resident in the United Kingdom are subject to CGT. So here we mainly focus on situations where individuals are subject to CGT. For that particular person, you have to be a UK resident person. You have to be a UK resident person. Then, how to calculate the capital gain for the purpose of CGT? Now, it's not a complicated computation. You have an asset, say land and buildings, or it might be shares. So you sell them for a particular price. We call them sales proceeds. And when you're selling something, there can be related expenditure. You may have to promote the product. You may have to advertise the product. So there can be expenditure relating to sales, and those expenses you have to deduct. Then you get an answer. We call it net selling price. From that, whatever the expenditure that you have incurred to acquire the asset, mainly the cost of purchase or any other capital expenditure, you can deduct it. Then you get an answer. We call it capital gain. You call it capital gain. But that is not the value on which you need to pay CGT. Now, in a given tax year, now for an individual, there is a tax year. If we are in 2019-20 tax year, you need to find out the disposals, the chargeable disposals that you have made during the tax year 2019-20. That means from 6th of April 2019 to 5th of April 2020. So say you have done three disposals during the tax year 2019-20. So for each disposal separately, you need to calculate the chargeable gain or the allowable loss. Say from disposal 1, you have a chargeable gain of 20,000 pounds. 20,000 pounds. And from the second disposal, assume you have a loss of 5,000 pounds. 5,000 pounds. And from the third disposal during the tax year, say you have a chargeable gain of 10,000 pounds. So during the tax year, you have done three disposals, out of which from two disposals you have generated capital chargeable gains, but from one disposal you have incurred a loss. Then what you should do is, there is a current year capital loss that must be set off against the other chargeable gains. So if there is a current year loss, the maximum possible amount must be set off against the chargeable gains in the same year. So here you have 30,000 chargeable gains, and from that the maximum possible amount, the maximum possible current year loss must be set off against that 30,000. So then you get an answer 25,000 pounds, and that is what we call net chargeable gain. That is what we call net chargeable gain. So if you have a current year capital loss, you need to set off the maximum possible amount. You need to set off the maximum possible amount. So here we are discussing capital gains tax, as I mentioned at the very beginning. So 25,000 pounds, from that you can deduct the annual exempt amount available. For the tax year 1920, the annual exempt amount available is 12,000 pounds. Then the balance chargeable gain after the annual exempt amount is 13,000 pounds. If you have brought forward any capital loss after deducting the annual exempt amount, if there's any remainder, from that you can deduct any capital losses brought forward. But remember, when you're deducting capital losses brought forward, unlike current year capital losses, you do not have to set off the maximum possible amount. So try to understand that distinction as well. If it is a current year capital loss, you don't have a choice there. You need to set off the maximum possible amount. You need to set off the maximum possible amount. But if it is a capital loss brought forward from a previous year, if it is a capital loss brought forward from a previous year, in that case, you don't have to set off the maximum possible amount. You just have to set off whatever the amount you like. So it's not a must for you to set off the maximum possible amount. You can decide how much of the brought forward loss you can set off. But in this instance, assume you have only a capital loss brought forward of 2,000 pounds. Then you can deduct that amount. After that, you get an answer. That is what we call taxable gains. That is what we call taxable gains. By the way, here I am explaining the CGT computation for an individual. When it comes to companies, there is nothing called CGT. If a company has a chargeable gain, they will have to pay COPE taxes on that chargeable gain. They will have to pay COPE taxes on the chargeable gain. But when it comes to an individual, there is a separate tax regime called CGT on their taxable gains. Right. So they are permitted to deduct an annual exempt amount, and if you have any capital losses brought forward, you can set off against any chargeable gain after deducting the annual exempt amount. And here it's an optional relief, capital losses brought forward. You can decide how much you want to set off, and then you get a taxable gain. On taxable gain, you have to pay CGT. Now the CGT rates, the appropriate rate depends on the nature of the taxable gain. So here we can identify two types of taxable gains. One is gains arising on or arising from residential properties. If the gain arises from a residential property, then as a basic rate taxpayer, you will have to pay at the rate of 18%. But if you are a higher rate taxpayer, where your taxable income exceeds 37,500, then you have to pay at the rate of 28%. And then rest of the gain, you call it other gains. Any gain which does not arise from residential property, any gain which does not arise from residential property, we call them other gains. As a basic rate taxpayer, you have to pay CGT at the rate of 10%, otherwise at the rate of 20%. So anyway, the rate that applies to you depends on the nature of the taxable gain and plus whether you are a basic rate taxpayer or not. Okay, right. So that's how you determine the tax rates that are applicable here. And then the next thing, so here you can see, as a basic rate band taxpayer, normally 10%, but if the gain arises from a disposal of residential property, then it's at 18%. If you are not a basic rate taxpayer, if your gains exceeds basic rate band, which is 37,500, in that case, it should be taxed at the rate of 20%. But if it is residential property gains, then at the rate of 28%. Okay. Now, these are commonly tested situations at the exam, especially this part disposal computation. Now, part disposal computation is a situation where you don't sell the whole asset. So let me quickly use this example. So assume you have bought this land. Assume that this is a land and you have bought it for 10,000 pounds. The whole land you have bought for 10,000 pounds. Assume you are selling only part of the land. Say you are selling only this part of the land. I'll call it A. And the remainder, I will label it as B. So assume you are selling this part A. Part A, say you are selling it for 30,000 pounds. 30,000 pounds. Then a question arises, what is the cost attributable to part A? Because you bought the whole land for 10,000 pounds, but you're not selling the whole land here. You're merely selling part of the land. So then we have to find out of this 10,000 cost, what is the cost attributable to part A only? And for that purpose, we are using this formula. So the cost 10,000 is for the whole land, must be split between A and B. How do you split this cost between A and B? Using this formula, that is A divided by A plus B into cost. Now this is how you have to do it. Cost is 10,000 pounds for the whole land. 10,000 pounds for the whole land. 10,000 into A. A means here, A means the market value of A at the time of disposal. What is the market value of A at the time of disposal? 30,000 pounds. The market value of A at the time of disposal is 30,000 pounds, and that answer divided by A plus B. A, we know it's 30,000, and at the same time, we require the value of the balance part as well. The market value of B. Assume the market value of B at the time of disposal of part A is 50,000 pounds. So A plus B is 30,000 plus 50,000 pounds. 30,000 plus 50,000 pounds. So this is how you split the cost between A and B. This is how you This is how you split the cost between A plus B. So 10,000 into 30,000 divided by 30,000 plus 50,000. So here you can get the answer. How much is the cost now? So let me get the value. 30,000 divided by 80,000 multiplied by 30,000 divided by 80 multiplied by 30,000. You get, okay, I'm sorry, 10, not 30,000, 10,000 divided by 80,000 multiplied by 30,000. You get 3,750. 3,000. Arun, the answer should be 3,750. So the cost attributable to part A is 3,750. So from 30,000, then you should deduct 3,750 to get the chargeable gain arising from the disposal of part A. So out of this 10,000, 3,750 is the cost attributable to part A. And the balance cost, that is 6,250, is attributable to part B. So this is how you do the computation for when there is a part disposal. And likewise, if there is a short-term lease is a situation where the lifespan of the lease is limited to 50 years or less. Then we call it a short-term lease. Now, if you have got a lease right, say you have got a lease for 40 years, but after 10 years time, you have decided to sell the balance 30 years of the lease right. It's a right actually that you're having. A lease right where is a situation where you are permitted to utilize a particular asset, say it's a land or a building. So you have got the building for a period of 40 years. So you have the right to use it for 40 years. But after 10 years time, you may decide to sell the balance 30 years to someone else. So a new person can come and occupy the premises and use the premises for the rest of the time period. So in that case, if you have obtained the lease for 40 years by paying 30,000 pounds, so you have obtained the lease for a period of 40 years by paying 30,000 pounds. After 10 years, you are selling the lease right to someone else. So the person who's acquiring the lease will be able to use it for a period of 30 years. So here, this 30,000 cost that you have incurred is actually for a period of 40 years. So you need to find out what is the cost attributable to the balance 30 years out of this 30,000. Then what you should do is at the exam, if you get a question like this, they will give you a particular percentage allocated for 40 years. So some percentage will be given, and for 30 years also, you will be given a percentage. So you have to divide, say, 155.8, or something like that, you will be given a percentage. So here also, you will be given a percentage. So this 30,000, you divide the percentage, you divide by the percentage allocated at the time of acquisition and multiply it by the percentage at the date of disposal. So there you have not been given questions from this area, but since it's there in the syllabus, I have just explained it. And then when it comes to chattels, I explain how the situation works. So there are two types of chattels, wasting and non-wasting. And normally wasting chattels are exempt from CGT. Non-wasting chattels are chargeable for the purpose of CGT. However, if you have bought and sold the asset for 6,000 pounds or less, then they are always exempt from CGT. Okay. Then when it comes to CGT computations, there is a very important thing that you guys need to remember. There's a very important thing that you guys need to remember. That is, whenever you're calculating the chargeable gain or the allowable loss as your sales proceeds, you have to take the market value. Even if it is a gift. Now, if it is a gift, you know that the seller or the owner, we call him the donor actually, he does not receive any money. So if it is a pure gift, in that case, you're transferring the ownership to someone else free of charge. So your actual sales proceeds will be zero. Your actual sales proceeds will be zero. Actual, if it is a gift, you know, the actual sales proceeds will be zero if it is a gift. Okay? However, for the purpose of CGT, you have to ignore the actual sales proceeds in this situation, even though it's a gift. To calculate the chargeable gain or allowable loss, you have to still take the market value as your deemed sales proceeds. So you have to ignore the actual sales proceeds and should use the market value as your deemed sales proceeds. So here the actual sales proceeds are zero. Assume the market value is £15,000. So to calculate the chargeable gain or the allowable loss, you should use the market value. Now this is the situation if the recipient of the asset is a connected party. If you have transferred the asset to a connected party, it can be even a genuine sale to a connected party. You should take the market value as your sales proceeds. So if you have sold the asset to a connected person, in that case, you have to ignore the actual sales proceeds and should take the market value as your sales proceeds. Now, who is a connected person? Your parents, grandparents, their spouses, your brothers, sisters, their spouses, your business partner, especially if it is a partnership, the other partners of the partnership, and the partner's spouses are considered as connected parties. Your children, grandchildren, their spouses are treated as partners. And not only that, your spouses, parents, grandparents, your spouses, brothers and sisters, their spouses, all of them should be treated as connected party. So if you have transferred an asset to a connected party, HMRC will always use the market value as deemed sales proceeds because there's a higher possibility that you will transfer the asset at an undervalued price because you are selling the asset to a connected party. So there's a higher possibility that you will sell the asset below the market value. But when you are calculating capital gains or allowable loss for the purpose of CGT, in that case, you have to ignore the actual sales proceeds and you should take the market value as your deemed sales proceeds. Use market value instead of actual sales proceeds. So that's something that you need to remember when you're doing the computation. Okay, right. Then the other thing is, as I mentioned at the beginning, a disposal is not only a sale of an asset. It's not only a gift of an asset. Even if the asset is lost or destroyed, it is treated as a chargeable disposal for the purpose of CGT, especially if the asset is completely lost or destroyed. That means the asset is no longer with you, but it is treated as a chargeable disposal. You have not willingly transferred the asset to anyone. It can be a situation somebody has stolen the asset or the asset has got destroyed, not intentional. But for the purpose of CGT, it should be treated as a disposal. It should be treated as a disposal. So in that case, the outcome depends on whether the asset is insured or not. If the asset is not insured, then you can calculate the normal loss available. For an example, if the asset is not insured, that means your sales proceeds are zero. Your sales proceeds are zero. Your sales proceeds are zero. Then assume that you have bought the asset for £10,000. 10,000 pounds. Then from zero, no sales proceeds, according to my example. So then you have a loss of 10,000 pounds. Then you have a loss of 10,000 pounds. But if the asset is insured, and if you receive insurance proceeds, then insurance proceeds received should be considered as sales proceeds. So sales proceeds will be your insurance proceeds. So assume here in this situation, asset is insured and the insurance company is paying a compensation of 12,000 pounds. Then you can deduct your cost from 12,000 pounds. You get an answer. So it's a profit of 2,000 pounds. So it can be even a situation where they pay you less insurance compensation. Assume you receive insurance proceeds of 8,000 pounds. Then that will be similar to your sales proceeds, and you deduct your cost. In this situation, there will be a loss of 2,000 pounds. There will be a loss of 2,000 pounds. So whatever the insurance proceeds received in that case should be treated as your sales proceeds and do the computation. So either it will be a chargeable gain or else an allowable loss. Okay. Further, the outcome can vary if you are going to use your insurance proceeds to purchase a replacement asset. Now, that's the situation where your asset is stolen or else destroyed, but it is insured. Therefore, the insurance company is now paying you compensation. However, you are not going to keep the compensation money received. Instead, you are going to spend that money to buy a replacement asset. Assume your necklace, an antique necklace, is stolen, but it's insured, and you receive insurance compensation. You're not going to keep that money. From that money, you are going to buy another necklace, a replacement necklace. That is what we call insurance proceeds are reinvested, and that must be done within a period of 12 months. Now here the computation is very much similar to a rollover relief computation that we have learned. So more than the computation under this kind of a situation, it is very important that it's extremely important for you guys to understand the computation with regard to rollover relief. The computation that we use for the purpose of rollover relief must be used here as well. So it's a similar computation. So in that case, if you have fully utilized the insurance proceeds that you have received, whatever the insurance proceeds received, now in this situation, 12,000 pounds. So assume you have fully utilized this £12,000 to buy a replacement asset within a period of 12 months from the date you received insurance compensation. Then you can defer the gain. That means you can postpone the gain and make a claim, make an election for no gain, no loss. So whatever the insurance proceeds that you have received, if you have fully utilized to buy a replacement asset, but within a period of 12 months, you can make an election to postpone or defer the full gain and pay no CGT right now. But in the future, you will have to pay more CGT. Here, what we do under this situation, we postpone the gain to the future. We defer the gain to the future. Therefore, we don't have to pay any CGT right now. But since we have postponed the gain to the future, in the future, the individual will have to pay more CGT. However, there can be situations where you do not fully utilize the insurance proceeds received. You may decide to keep some of the money with you and use the balance to buy a replacement asset. Now here, you got 12,000, but assume you spend only £10,000, £10,000 to buy the replacement asset. So you receive £12,000, but you spent only £10,000 to buy the replacement asset within a period of 12 months. So you did not spend how much? £2,000. You received 12,000. Use £10,000 to buy a replacement asset. The balance £2,000, you did not use it. So on that £2,000, on that balance £2,000, which you did not utilize from the insurance proceeds, will be subject to CGT. Will be subject to CGT. So on the balance amount, the balance amount you can defer or postpone to the future. Okay. So assume you have a profit of £6,000. Assume that you have a profit of £6,000. If it is a partial reinvestment, out of this gain £6,000, on £2,000 you will have to pay CGT immediately, but balance £4,000 you can postpone to the future and make the election of no gain, no loss only on this 4,000. How did we calculate this £2,000? We received insurance proceeds 12,000, but spent only 10,000. You have a remainder of £2,000 cash in hand. So out of the gain, on the cash in hand amount of £2,000, you have to pay CGT immediately. Only the balance 4,000 can be deferred or postponed to the future, and there later you will have to pay more CGT. Okay, right. Then this is a situation where the asset is not lost or destroyed. The asset is not lost or destroyed, but the asset is damaged. Now, what's the difference between asset lost or destroyed and asset is damaged? If the asset is lost or destroyed, you don't have the asset with you. You don't get the opportunity to use the asset at all because asset is stolen. So someone has taken the asset. Asset is destroyed, so the asset is no longer there with you for you to use it. But if the asset is damaged, that's a different situation. Asset is still with you. Asset is still with you. Assume it's a painting. The painting has got damaged. The painting has got damaged. Even though it has got damaged, the painting is still with you. Now, if you have a phone, it can get damaged, but you can still continue to use the phone in that damaged condition. Still, you can use the phone in damaged condition. However, for the purpose of CGT, even an asset which has got damage may be treated as a chargeable disposal. Not all the time. Just because the asset is damaged, it doesn't mean it's a chargeable disposal. However, under certain circumstances, it will be treated as a chargeable disposal. So if the painting is damaged and if the painting is not insured, no disposal, then it's an exempt disposal for the purpose of CGT. It's not a disposal for the purpose of CGT. It's not a disposal for the purpose of CGT if the damaged asset is not insured. But if the damaged asset is insured and you receive insurance proceeds, in that case, you need to consider it as a chargeable disposal. However, your chargeable disposal computation should be similar to a part disposal computation. It should be similar to a part disposal computation. Now, the painting is damaged. The damaged area of the painting, I would call it A, and the remaining part, which is not damaged, I will call it B. So a little while ago, I explained how to do the chargeable gain computation. If it is a part disposal, then you must adopt a similar computation here to calculate the chargeable gain arising from the damaged asset, which is now insured and receiving insurance compensation. All right. Now here, the outcome again depends on whether you're going to use the insurance proceeds to repair the damages or restore the damages. So insurance proceeds are received and you're not going to keep that money. You are going to use, you're not going to use that money to repair the damages. You're not going to restore the damages, then you do a normal part disposal computation. However, if you're going to use your insurance money to bring back the painting to the condition that it was prior to the damages, or to restore the damages or to repair the damages, in that case, you can make an election to postpone the gain. You call it rollover election, and don't think too much about it because this part will not be tested at the exam. Okay, right. Then, an important area. Now, when I was explaining inheritance tax yesterday, there also I specifically stated IHT implications on share disposals are extremely important. Likewise, you must have a very good knowledge with regard to the CGT computations pertaining to share disposals. How to calculate the CGT liability, or to how to identify the CGT implications when there is a disposal of shares mainly. Now this topic is important for the exam. Now here, when it comes to share disposals, you need to simply identify your sales proceeds. From that, you deduct your cost of shares. Then you get the chargeable gain or the allowable loss. Now, in certain situations, you need to calculate the sales proceeds. Example, what if you have gifted your shares to someone else? Gifting of shares to someone else. When you gift, do you receive money? No. But as we discussed previously, even though you have not received money, since it's a gift, to calculate the chargeable gain or the allowable loss, you need to use the market value of the shares, as your deemed sales proceeds. It may be a pure gift where you don't receive cash, but still, to calculate the chargeable gain or the allowable loss, you need to use the market value. Now, if it is unquoted shares, that is, a share which is not listed in the London Stock Exchange, you have no problem at the exam. You will be given the market value of the shares that you have gifted. But if it is a quoted share which is listed in the London Stock Exchange, then you may have to calculate the market value. So if it is a quoted share, how do you calculate the market value? You must take the lowest list price and the highest list price, you add them together and divide by 2 to get the average price or the mid price. So on the date of disposal, you identify the lowest list price, say it's £2. The lowest list price or the quoted price in the London Stock Exchange of the share is £2, and the highest price on that date, the list price, is £2.50. You add them together and divide by 2, you get the mid price or the average price, so which is £2.25. So based on this price, you need to now calculate the sales proceeds. So this is in a situation where you have gifted shares or where you have sold your shares under an undervalued price. Okay, right. So that's how you get the mid price when the selling price is not, when it is gifted or when shares are sold below the market price. Okay, right. Now, if you have sold the shares at an arm's length price at the market value, then you don't have any problem. The price will be given to you. Then you will be able to calculate the sales proceeds. Then the next difficulty that we face when ascertaining the cost of the shares. Now, assume you know the selling price. It's given in the question. However, now you need to find out the cost value of the shares. You need to find out the cost value of the shares that you have sold. You have sold some shares. You need to know the cost attributable to the shares that you have sold. However, it's not that straightforward. You have to face a practical difficulty when calculating the cost attributable to the shares that we have sold. What is the practical difficulty that you face here? You may have bought these shares on different dates at different time during different time periods, spending or paying different prices. Now assume you have sold 5,000 shares. You have sold 5,000 shares out of 8,000 shares that you are having. You're having 8,000 shares. Out of that, now you have sold 5,000 shares. 5,000 shares. Now a question arises, what is the cost attributable to these 5,000 shares? Now this 8,000 shares that you had previously, assume you have bought at different occasions. Now 1,000 shares 2 years ago, 3,000 shares 1 year ago, then another 3,000 shares on the date of disposal, another 1,000 shares within 30 days from the date of disposal. So likewise, you have bought these 8,000 shares at different time intervals, different time periods, and at different prices. The share price is always fluctuating. So it's not the price that is available today will be the price tomorrow. It is not the price that you spent 2 years ago that will be there when you're going to pay today. Now, in that case, you will see it's extremely difficult for you to identify the cost attributable to these 5,000 shares, because we do not know actually whether we have sold this 1,000 share that you bought 2 years ago. We don't know whether this 1,000 shares that you have bought 2 years ago is included in this 5,000. We don't know this 3,000 that we bought 1 year ago is included in this 5,000 pounds. We don't know this 3,000 pounds, 3,000 shares that we bought on the same date of disposal is the one that we have sold with this 5,000. We don't know this 1,000 shares that we bought within next 30 days included here in these 5,000 shares. Okay, so in that situation, you can see there is a practical difficulty when calculating the cost of the shares. Now, in such circumstances, we need to apply identification rules or matching rules to determine the cost attributable to those 5,000 shares that you have sold today. Everything depends on the date of disposal. So remember and memorize the identification rules. And you have 3 identification rules, and you have to apply them according to the order given. So date of disposal. Say it's 1st of February 2019. If you have sold 5,000 shares, first check whether we have bought shares on the same date of disposal. Check whether you have bought shares on the same date of disposal, and we have to assume we have sold the same shares on the date of disposal. There can be situation buying and selling on the same date of disposal. So first assumption is assume that we have sold shares on the same date of disposal, These are assumptions. If that is not enough to match this 5,000 shares, then we have to make very impractical assumption, but still you have to make that assumption. That is, you have to assume you have sold shares that you intend to purchase within the next 30 days. It is not practical for you to sell something that you have not bought yet. How can you sell something that you don't have today? But here we have to make the assumption that we have sold shares that we intend to purchase within the next 30 days from the date of disposal. This is what we call bed and breakfasting rule. Even though it's not practical, you have to make this assumption. Then, and I'm receiving several questions, but I must tell you, I have to continue because I have very limited time period. So some questions are very personal questions, individual questions, not helpful for the, not with regard to the topic that I'm discussing right now. So in that case, yesterday I shared the WhatsApp number, and today also towards the end of the session, I will share my WhatsApp number. And after that, you can ask whatever the questions that you're having. Depending on the time available, anyhow, I will try to answer, but I may not be able to answer immediately. But anyhow, I will answer those questions. So in that case, so during this time period, do not ask questions. But if it is relating to the topic that I'm explaining right now, please go ahead and ask questions. So when I'm explaining it, I will be able to address that as well. The other questions you can ask later through a WhatsApp message when I share the WhatsApp number towards the end of the session. All right. Okay. So let's do like that, and let me use the time effectively during this limited time period. Okay. Right. Then, if that also does not work, in that case, now, if that also does not work, then you need to prepare a share pool. So when you're preparing a share pool, we include the shares that you have bought prior to the date of disposal only. In the share pool, we include only the shares that we have bought prior to the date of disposal. So in the pool, we do not include the shares that we have bought on the same date of disposal and the shares that we intend to purchase within the next 30 days from the date of disposal. We include the shares that we have bought prior to the date of disposal in the share pool, and accordingly, we need to calculate the average price of a share and then multiply it by the number of shares that you have sold. So let's see whether we can answer a question. Once I'm done with the theory explanation, I will be giving you a break like yesterday for 15 minutes. And after that, we will be discussing questions in that I may be able to do a small share pool computation. So, but let's look at, I'll be discussing some past papers within the time period available. All right. Okay. Then, even if you have received bonus shares, they must be included in the share pool. But when you are including bonus shares in the share pool, the share number of shares will be added, but there's no cost. You know the difference between a bonus share and a right share? The only difference is bonus shares are given free of charge, whereas right shares are given below the market value at a discounted price. But the similarities, both bonus shares and right shares are given to the existing shareholders of the company. So if a bonus share is given to the existing shareholders, they receive shares free of charge without making any payment. And if it is a rights issue, they can purchase shares normally below the market value at a discounted price. In that situation, bonus or right shares all must be included in the share pool. Okay. Now this is a very important slide where you need to have a proper understanding, because at the exam when they are giving questions, to make the computation complicated, they may include a takeover situation. Now I must tell you here, I have been given 15 hours altogether during a period of 5 days. So every day I'm spending 3 hours. Now that is definitely not enough to cover a syllabus like P6 Advanced Taxation. I'm here to do a revision session. So in that case, unfortunately, I have to make an assumption that you have gone through the topics, and I'm just here to explain the nitty-gritties and the important aspects. So I'm not in a position to explain each and everything, even though I wish I could do something like that, but the time I have been allocated is very much limited. So within this time period, I may only be able to explain the main elements with regard to the topic that I have selected. So there I am telling you, I may not be able to explain each and everything in depth, but I will tell you these are the important areas that will be required for the exam. That means once you are done with the session, using your own time, you should spend time to learn these aspects because these are highly examinable areas. So one such area that can be tested all the time at the exam is a takeover scenario, Now, when it comes to a takeover scenario, how does it work? There what happens is an individual has bought shares in a particular company, say A Limited. And now this A Limited is acquired by B Limited. Assume all the shares of A Limited 100% acquired by B Limited. In that case, what happens is effectively this individual is selling his shares to B Limited. So assume he has 5,000 shares in this company that he has bought for 10,000 pounds. So if A Limited has been taken over by B Limited, effectively what has happened, this individual who owned 5,000 shares has now sold or transferred to B Limited. B Limited has bought these 5,000 shares from from this individual to become the shareholder of A Limited. So that means B Limited is required to pay to this particular individual for these 5,000 shares that they have bought. Assume B Limited has paid 30,000 pounds. Cash paid 30,000 pounds for these 5,000 shares that they have bought from this particular individual who himself has bought for 10,000 pounds in the past. So here what has happened, he bought them for 10,000 pounds and now these 5,000 shares he has sold to B Limited for 30,000 pounds and there you get a chargeable gain of 20,000 pounds. So there we have no problem. As a result of the takeover, if the shareholder has received money, then you calculate the normal chargeable gain or the allowable loss. However, the situation will be different if the individual has not received cash. Instead, assume he has received some shares in B Limited. That, in other words, we call it share for share exchange or paper for paper exchange. Share for share exchange or paper for paper exchange. What do you mean by share for share exchange or paper for paper exchange? That's a situation. Share for share exchange or paper for paper exchange is a situation where the individual has now received shares in B Limited instead of the shares that he had in A Limited. Earlier, he had 5,000 shares in A Limited. After the takeover, now he has shares in B Limited. Share for share exchange. So here, there's no actual chargeable gain or allowable loss. Effectively, what happened was, instead of the shares that he had in A Limited, now he has shares in a different company called B Limited. He didn't receive money. He didn't pay anything extra. The only thing what happened was his investment changed. Earlier, his investment was in A Limited. Now he has his investment in B Limited. And now he has become a shareholder of B Limited instead of A Limited. In this situation, you can make a claim or you can make an election for no gain, no loss. You can make an election called no gain, no loss, so you don't have to pay any CGT at that point. But for that, there are certain conditions that must be satisfied. That is, one important condition is, as a result of the takeover, the other party, the B Limited in this situation, should acquire more than 25% of the company, and it has to be a genuine commercial transaction. Bona fide means in good faith. So it has to be a proper, genuine commercial transaction. And here, what happens is, he becomes a shareholder of B Limited. Assume he receives shares in B Limited, say he gets 15,000 ordinary shares in B Limited. Earlier, he had 5,000 shares in A Limited. Now, instead, he has 15,000 shares in B Limited. At some point, if he sells his 15,000 shares, then you have a problem. What is the cost attributable to these 15,000 shares? You don't have to worry too much about this, because your original cost 10,000, which you spent to buy 5,000 shares in A Limited, now becomes the cost of these 15,000 shares. So the original cost that you incurred to buy shares in A Limited also becomes the cost of the shares that you have now got in B Limited. So cost of original shares, in my example, 10,000 pounds, becomes the cost of the new shares, that is 15,000 shares. Okay, right. However, there can be situation you receive mixed consideration. You receive mixed consideration. What do you mean by mixed consideration here? Here, mixed consideration means, example, listen carefully and try to understand what I am explaining, then only you will be able to concentrate. And after that, think about the areas that you cannot understand. After that, you can raise questions from me, as I mentioned, even once the session is over, through my WhatsApp. Here, what you should do is focus on what I am explaining. Otherwise, you will not be able to understand what I am explaining here. Okay? Because you will listen to part of it, and then without understanding the full thing, if you start answering questions, then the question will not be a proper question. So listen to the explanation throughout, and most of the time you will be able to clarify your doubts throughout my explanation. Okay, right. Now, A Limited, so we call him X, an individual who's having 5,000 shares in A Limited, which he has bought for 10,000 pounds. Which he has bought for 10,000 pounds. Now acquired A Limited by B Limited. Acquired A Limited by B Limited. Assume as a result of the takeover, X receives both shares and cash from B Limited. Not only shares, assume X is receiving little bit of cash as well. Little bit of cash as well. I'm taking my time here to explain this because there can be questions at the exam. Assume you receive 10,000 shares, which has a market value of £2. That means 20,000 pounds. 20,000 pounds. And assume at the same time you receive cash £1 for each share that you held in A Limited. You held 5,000 shares in A Limited. For each share that you held in A Limited, you are paid £1. So you get 5,000 cash. So altogether, the value is 25,000 pounds. Altogether, value is 25,000 pounds. Now this is mixed consideration because you have received both cash and shares. You have received both cash and shares. In that case, for the cash amount that you have received, there might be an immediate chargeable gain. On this £5,000 that you received, you may have to pay CGT immediately. However, that depends on whether the cash amount received is small or not. If the cash amount received is a small cash amount that you have received, then you don't have to pay CGT immediately. But if the amount of the cash that you have received is not small, then there is an immediate CGT. Then how do you determine whether it's a small cash transaction or not? This is the criteria. If the value of the cash received is equal or less than £3,000, equal or less than £3,000, definitely it's a small cash amount. If it is £3,000 or less, definitely it's a small cash amount. It's a small cash amount. Then no CGT. There can be a situation where the cash amount received is more than £3,000, but if the amount received is equal or less than 5% of the total value. Now here, what is the total value received? What is the total value of the shareholding? £25,000. £25,000. Take 5% of that. Take 5% of that, which is £2,500. £2,500. So if the cash value received is 2,500 or less, in that case, it's a small cash transaction. But here what you should do is, it's 2,500 and the other value is £3,000. From the two amounts, you take the higher value. Higher value is 3,000 and the cash amount received is more than £3,000. Therefore, it's not a small cash transaction. Since it's not a small cash transaction, you need to calculate the chargeable gain on this 5,000. Then a question arises, cash received is £5,000, but what is the cost that you have to deduct from this £5,000? What is the cost attributable to this £5,000? In that case, you need to do a part disposal computation. You need to do a part disposal computation. I'm sorry, here 5% of 25,000 is 1,250. My mistake. Huh? Thank you very much for correcting me. So 25,000 into 5% is 1,250. So from 1,250 and 3,000, you take the higher value, and then you compare with the cash amount received. So if the cash amount received is more than the higher value that you have selected, in that case, it's not a small cash transaction. You have to do a part disposal computation. Okay, right. Here, the cash amount received is more than £3,000. Therefore, it's not a small cash transaction. Therefore, you have to do a part disposal computation. So when you're doing the part disposal computation, you have received cash 5,000. You need to find out the cost attributable to this 5,000. Your original cost of your investment is how much? £10,000. You originally spent £10,000 to invest in shares in A Limited. Now this 10,000 cost, you have to split between the shares received and the cash amount you received. Your original cost becomes the cost of the shares and the cash that you have received. So you need to split this 10,000 between shares and cash using the normal part disposal computation. So how do you find out? 10,000 divided by A plus B. A means the cash amount received, £5,000. A plus B means 5,000 plus 20,000, so divide by 25,000 pounds. So here you get an answer of 2,000 pounds. So you spent 10,000 pounds originally. From that, the cost attributable to 5,000 cash that you have received is 2,000 pounds. So from 5,000, you deduct 2,000 pounds, you get the chargeable gain. And balance 8,000 of the cost is attributable to the remaining shares that you have received. At some point, if you sell these 10,000 shares, you need to deduct 8,000 cost to find out the chargeable gain or allowable loss. So we may be able to do a computation on this. I just explain it, but I must repeat myself. This is an important computation that you need to understand. Okay. So with regard to QCBs, qualifying corporate bonds, you know that qualifying corporate bonds are exempt from CGT. Qualifying corporate bonds are exempt assets from CGT. And then stamp duty tax. Stamp duty tax is actually a part of CGT, because when you sell lands, it will be subject to stamp duty land tax. I'm not going to explain in detail here because the rates are given to you at the exam, but always there can be a question for 1 mark or half a mark at the exam from stamp taxes. So here you have only two types of stamp duties applicable. That is one when you're selling land, then the stamp duty tax applicable, we call it stamp duty land tax, and that is a tax that must be paid by the buyer of the land. And likewise, we have stamp duty chargeable on share disposals. Normally, it is 0.5%, 0.5% on the share value. So minimum £5. When you do the calculation, sometimes you may get an answer below £5, but still you have to pay. It's like this. If the share value is for every £1,000, you have to pay £5 as stamp duty. So as a percentage, it's 0.5%. If you convert this into a percentage, you get 0.5%. But it means for every 1,000 every 1,000 value of a share, you have to pay at least £5 as taxes. So if it is 2,000 pounds, then you have to pay £10 as stamp duty. So that's how it works. Not a complicated computation. So please go through that part as well. Now this is definitely an important area. I have only 7 minutes left for me to complete the theory part. So then I will give you a break for 15 minutes. Once we are back from the break, I will be discussing some questions. But what I want to tell you here, I may not be able to explain all the reliefs that we have, but make a note, definitely you need to go through maybe 4 or 5 times, it doesn't matter, until you understand, go through all the reliefs available on capital gains. So there are several reliefs available to an individual. One we call entrepreneur's relief, and then we have another relief called investor's relief. We have rollover relief, we have gift relief or holdover relief, and then we have something called incorporation relief. Then all those reliefs are available on business assets. Incorporation relief, entrepreneur's relief, investor's relief, rollover relief, gift relief, all those reliefs are available on business assets used for the purpose of business. However, there are 2 reliefs that are available on residential properties and assets used for the purpose of and as a house used for residential purposes. So if you sell your main residence, the place where you have lived as your home, then the chargeable gain will be exempt under PPR relief, Principal Private Residence Relief. And another additional relief that you can claim when you dispose your main residence, that is what we call letting relief. So for you to claim Principal Private Residence Relief, you are required to occupy the premises during the period of ownership. If the property is vacant, empty, and that you don't occupy, in that case, your relief will be reduced. So an essential requirement for you to claim the Principal Private Residence Relief is you need to occupy the premises during the period of ownership. But when you say occupation of the premises, occupying the premises, it does not mean you have to physically occupy, because there's something called deemed occupation, and there are 4 rules with regard to deemed occupation. I will briefly explain the deemed occupation rules. Do you need to memorize them? So when it comes to deemed occupation rules, if you are employed abroad, then any time period will be considered as deemed, any time period will be considered as deemed occupation, though you are absent from the property. So if you are employed in the United Kingdom, or else you are self-employed abroad or self-employed in the United Kingdom, then for 4 years, 48 months, you can claim as deemed occupation, and any 36 months you can claim as deemed occupation for any reason, and last 18 months also considered as deemed occupation, even though you actually and physically reside in that premises. Okay, so that is not a very important relief actually, but entrepreneur's relief is a very important relief here. Now you need to identify the situations where you can claim the entrepreneur's relief. Now, entrepreneur's relief is available on several occasions. One is a situation you sell the unincorporated business. So if you are selling the whole business or substantial part of the business, then entrepreneur's relief is available when you are transferring the assets, provided the asset is a chargeable asset and used for the purpose of business. So if you are selling the whole business or substantial part of the business, then you can claim entrepreneur's relief on such chargeable gain. So what is the relief that you get there? The relief available is whatever the gain will be taxed at the rate of 10%. So on the entrepreneur's relief, the relief that you can claim is your chargeable gains will be taxed at the rate of 10% only. So even though you're a higher rate taxpayer, normally you should pay taxes at the rate of 20%, but in this instance, you will have to pay taxes only at the rate of 10%. However, there is a lifetime limit available on the entrepreneur's relief throughout the life of an individual. The maximum amount on which you can claim entrepreneur's relief is limited to 10 million. Okay, and this relief is available only on certain circumstances. One, as I said, you're selling the whole business or substantial part of the business. The other commonly tested situation is when you're selling shares from a personal trading company. Now, what is a personal trading company? That is a situation where you own at least 5% or more of the ordinary share capital of the company. For you to claim entrepreneur's relief on a share disposal, you need to satisfy 3 conditions. You need to satisfy three conditions. One is it has to be a personal trading company where you own at least 5% of the ordinary share capital, and you should be an employee of the company, and you should own shares in the company at least for a period of 2 years. Even for other situations that you have been given here, you need to own the property or any other asset at least for a period of 2 years. So this is the commonly tested one, the second one. The third one, you need to understand normally when you're selling an individual asset, you cannot claim entrepreneur's relief. However, if you are selling an individual asset from an unincorporated business where you have ceased trading, that means the business is no longer in operation, you have ceased business, you have stopped doing business from a business like that, from a business where you have ceased trading. If you sell an individual asset within a period of 36 months from the date of cessation, then you can claim the entrepreneur's relief. And then we have another special relief called associated disposal that I will try to explain after the break when I'm doing a question. This has been tested at the exam as well. And then the other situation is exclude goodwill transfer to related goodwill related to closed company. Now, this is something that you need to be cautious. If you're converting your unincorporated business into a company, and if that company is a closed company, what is a closed company? A closed company is a company where it is controlled by 5 or less than 5 shareholders. If the company is controlled by 5 or less than 5 shareholders, you call it a closed company. So if the company is controlled, if the business is converted into a closed company on goodwill, you cannot claim entrepreneur's relief. Normally on goodwill, you can claim entrepreneur's relief. But if the business is transferred to a closed company, on other disposals, you can claim entrepreneur's relief, but not on goodwill. So this relief and rollover relief, investors relief, then gift relief, all are extremely important for the exam. So make sure, even though I explain it or not, you guys need to go through it properly at least 4 or 5 times until you understand it. Definitely it will be useful for the exam. So since I'm actually taken more time to explain the theory part, so we'll take a short break for 15 minutes, and after that we'll meet up again after 15 minutes to discuss some questions from CGT. So let's take a break for 15 minutes and meet again after 15 minutes time. Okay. Thank you guys. See you in 15 minutes. Okay, let's start. Now, let me go through some questions from capital gains tax. Let me download the document. Okay. Yes, but not the answers. Not the introduction again. Questions. One second, guys. Yeah, let's answer question number 28. Now, as I mentioned, and as we discussed yesterday, when you get questions at the exam, the nature is such, they include both IHT and CGT in the same question. So we should have an ability to identify both IHT implications and CGT implications in a given scenario. Okay. Yeah, sorry for that. Now, when you're studying, study inheritance tax and CGT together. So when you're allocating time, Before moving to the question, I will give you some advice that you can consider when you prepare yourself for the exam. Now, there are topics allocated on unincorporated businesses, that is, starting a new business, ongoing business, cessation of a business, unincorporated business. Study those chapters separately. Inheritance tax and CGT chapters must be discussed at once at the same time. So then you will be able to see similarities and differences between the two taxes. More than similarities, the relationship between the two taxes, which is extremely essential when answering questions at the exam. Otherwise, you will find it difficult. Then corp taxes separately, value-added taxes separately, you can study. Now, if you look at question number 28, question number 28, okay, we'll answer this question. We'll answer this question. Now, here, first we will read the required part. First we will read the required part. Roman 1, state the conditions that must be satisfied for ASHA's assignment of the lease to be an associated disposal for the purpose of entrepreneurs relief. Before giving you the break, I mentioned that there are several situations where you can claim the entrepreneurs relief. One such situation is if the disposal falls within the category of an associated disposal, you are in a position to claim the entrepreneur's relief. So first of all, we need to find out the meaning of an associated disposal. The meaning of an associated disposal. First, we will answer that question. ASH requires a calculation of his capital gains tax liability for the tax year 1920. So at the very beginning also, they give you a summary. Required part, you identify what you're supposed to do. And when you read the first paragraph itself, you realize what you are expected to do under that particular question. Okay. So ASH requires a calculation of his CGT liability together with advice in connection with entrepreneurs relief, registration for the purpose of value-added tax that I'm not going to explain here, and payment of income tax that is also not part of today's topic. So anyway, I'm going to answer CGT liability together with advice in connection with entrepreneurs relief. Okay. As is resident in the UK, has taxable income of 29,000, was the owner and managing director of Lava Limited until 1st of May 2019, when he resigned and sold the company. He's a partner in the Vulcan Partnership. So he's the owner, managing director of a company called Lava Limited, and until 1st of May 2019, when he resigned and sold the company, is a partner in Vulcan Partnership. Disposal of capital assets in the tax year 2019-20. The sale of shares in Lava Limited resulted in a capital gain of 235,000, which qualified for entrepreneurs relief. has designed a 37-year lease on a property for £110,000 on the 1st of May 2019. Has sold 2 hectares of land on 1st of October 2019 for £30,000 and sold quoted shares, made a capital loss of 16,500. Made a capital loss of 16,500. Okay. Now, the lease was previously assigned to Ash for 31,800 when it had 46 years remaining. The property has always been used by Lava Limited for trading purposes. Lava Limited paid Ash rent equivalent to 40% of the market value in respect of the use of the property. Okay. Now, what I read up to here will be adequate enough for us to answer part A. State the conditions that must be satisfied for Ash's assignment of the lease to be an associated disposal for the purpose of entrepreneur's relief. Okay. Now, what has happened here? It is extremely important at the exam for you to take adequate time to read the question carefully and understand the sequence of events and the connection between the transactions that you have been given, if any. Now, in this situation, he was the owner and the managing director of Lava Limited until 1st of May 2019. Now, the sale of shares in Lava Limited resulted in a capital gain of 235,000, which qualified for entrepreneur's relief. In this instance, we don't have to waste our time to find out whether the share disposal qualifies for entrepreneur's relief. However, as I mentioned previously, for you to claim the entrepreneur's relief on a share disposal, you have to satisfy 3 conditions. 1, it has to be a personal trading company where you own at least 5% of the ordinary share capital. You should be an employee of the company and you should own the shares at least for a period of 2 years. It seems that you have met the 3 conditions that I mentioned. As a result of that, the capital gain that resulted from the sale of shares in Lava Limited qualifies for the entrepreneur's relief. So we don't have to think too much about that. And what is this associated disposal? So you were a shareholder, that means an owner of this company, Lava Limited. And you sold your shares in this Lava Limited at a gain of 235,000, which qualifies for ER. So the share disposal, listen very carefully, the share disposal qualifies for the entrepreneur's relief. This is the main transaction. It qualifies for the entrepreneur's relief. And you would have noticed the assignment of the lease also has some connection to this Lava Limited. What is the connection? Now, Ash, who is the shareholder of Lava Limited, has got the lease under his name for 31,800. So he has spent a cost of 31,800 the cost of 31,800 to acquire the lease when it had a remaining lifespan of 46 years. The property has always been used by Lava Limited for trading purposes. So this leased asset, the leased building, actually used by Lava Limited for the purpose of trading, and for that, Lava Limited has paid a rent to Ash, who is the shareholder of the company, equivalent to 40% of the market value. So if the market value is 100, Lava Limited has paid a rent of 40 pounds to the shareholder, to Ash, who is the shareholder of this company. So from the market value, rent paid is 40%. And then what has happened, Ash, who was the shareholder of this company, decided to sell his shares, and at the same time, he decided to, let me show you that part. He decided to assign the lease. He decided to transfer the lease to this company. Now, Ash assigned a 37-year lease on a property for 110,000. Now, we need to understand this lease assignment, sale of the lease right, is actually a single asset disposal. A single asset disposal. You have a leasehold asset. You can occupy it for 47 years, 46 years. Then you used it for some time, and then you decided to sell your lease right when there's a remaining lifespan of 37 years. So actually you have used it for 9 years, and then you have decided to sell the lease right when it has a remaining life of 37 years. As I mentioned previously, entrepreneur's relief is normally not available when you sell an individual asset. When you sell an individual asset, normally the entrepreneur's relief is not available. However, if it falls within the category of associated disposal, then you will be able to claim entrepreneur's relief even on that single asset disposal. What do you mean by associated disposal? That means the disposal is connected to something. It is associated with something, connected to something or associated with something. It is connected to what? Ash's share disposal in Lava Limited. Previously, he was the shareholder, the only shareholder of Lava Limited, and he allowed the lease building to be used by Lava Limited. He allowed Lava Limited if you now my voice is clear, I can see it from the microphone. So others also don't have any problem. So that means it has to be from your end. So I believe then you need to check from your side kindly, right? Okay. Now, yeah, coming back to the topic that I was explaining. So associated disposal is something connected to another disposal. That is why we call it is an associated disposal. Now, if you look at the situation that we have, Ash was the only shareholder of Lava Limited, and Ash allowed Lava Limited to use the leasehold premises owned by Ash. And for that, he charged a rent, but he did not charge the full commercial rent. He charged only 40% of the commercial rent. Now what has happened? He has decided to leave this company by selling the shares in Ash Limited. He has decided to sell the shares in Lava Limited by selling the shares. At the same time, he has realized now no point of allowing Lava Limited to use his leased premises at a rate of 40% of the commercial rate, not favorable to him. Therefore, at the same time, while leaving the company by selling the shares, at the same time, he has decided to transfer or sell his lease right as well. So you can see, even though the share disposal and the transfer of the lease right are two different transactions, they are actually connected to each other. They have some kind of an association with each other. What is the association? I am actually selling my lease right because I am no longer the shareholder of this company. Therefore, the two transactions are connected to each other. Since I'm leaving the company as a shareholder, I want to now sell my lease right also at the time of leaving. So the assignment of the lease is an associated disposal. That means it is connected with the share disposal that we have made. If the transaction falls within the category of associated disposal, if you have been able to claim the entrepreneur's relief on the main disposal, which is the share disposal here, you can extend your entrepreneur's relief to the associated disposal as well. So if you have been able to claim the entrepreneur's relief on the main disposal, which is the share disposal here, that relief you have obtained can be extended to the associated disposal, though it is a disposal of a single asset. So this is what we call an associated disposal. So what are the conditions that we have to satisfy in order to claim the entrepreneur's relief on the associated disposal? The first condition is, if you have not been able to claim the entrepreneur's relief on the main disposal, no ER on the associated disposal. So first condition is, the shares in Lava Limited, the disposal of shares in Lava Limited must qualify for the entrepreneur's relief. Now that condition is satisfied here. That condition is satisfied here because the question itself says the chargeable gain qualifies for entrepreneur's relief. So what's the first condition? The share disposal in Lava Limited must qualify for entrepreneur's relief. Then the next condition is, the lease, the associated disposal asset, must have been owned by Ash and used by Lava Limited for the purpose of trade at least for a period of 2 years. So the next condition is, the leased property must be owned by Ash and it should have been used by Lava Limited for the purpose of trading at least for a period of 2 years. And the third important condition is, Ash Limited should not charge a rent for allowing Lava Limited to use it for trading purposes. Ash should not charge a rent. It has to be actually free of charge, and Lava Limited should be able to use the asset without paying any rent to Ash. But in this instance, a rent is paid to Ash. However, he is not paid the commercial rent. Therefore, from the chargeable gain, from the chargeable gain that arises from the associated disposal, the chargeable gain that arises from the associated disposal, since you are charging 40% of the commercial rent available in the market, 40% becomes chargeable, but on the balance 60%, of the chargeable gain, you can claim the entrepreneur's relief. If you did not charge any rent at all, then the whole chargeable gain would have qualified for entrepreneur's relief. But since you are charging 40% rent of the commercial rent available in the market, but that 40% chargeable gain, 40% of the chargeable gain, entrepreneur's relief is not available. But on the balance 60%, you can claim the entrepreneur's relief. So this is how it works in this situation. Now, let's look at the next part of the question. Calculate ACCA's capital gains tax liability for the tax year 2019-20 on the assumption that the assignment of the lease does qualify as an associated disposal and that entrepreneur's relief will be claimed where possible. The following lease percentages should be used where necessary. For 46 years, this is to calculate the chargeable gain that arises from the disposal of the lease right. So let me explain how it works. So 3 marks and 7 marks, so altogether 10 marks allocated for the purpose of CGT. But it's not actually a very complicated question provided you are familiar with the relevant principles. So now let me do the computation. So as I mentioned yesterday, at the exam, when you are using computer-based platform, you're given the opportunity to use a sheet similar to normal Microsoft Excel, but be cautious. The most of the options available in this normal Microsoft Excel spreadsheet will not be available in the platform or in the spreadsheet given to you at the exam. So anyway, let me now answer the question. So there are several disposals that have taken place during the year, and some qualifies for ER and some does not qualify for ER. Qualifies for ER, not qualifying for ER. At the exam also, you will be able to do the question side by side while you're looking at the question. Okay. Now, what are the disposals? One is the sale of shares in Lava Limited. Sale of shares in Lava Limited. So what you can actually do is, for you to understand how it works, yesterday I explained, through MyACCA, you are permitted to use the same platform that you have to use at the exam. So best thing is to practice your questions using that platform. Then you will not be having any problem. So if you are going to use the platform for the first time at the exam, then there will be a problem because you will not be comfortable with it. So for you to be comfortable, so please go to through MyACCA, you can, yesterday I explained how to use it, how to approach there, how to reach there, and then at the exam, you will not be having any problem. So practice your question using that platform. So sale of shares, the question itself specifically states that a capital gain of 235,000 qualifies for ER. 235,000 qualifies for ER. And then Ash assigned a 37-year lease on the property for £110,000 on the 1st of May 2019. So then we'll take a separate working. We'll take a separate working to calculate the chargeable gain from the assignment of the lease. Assignment of the lease. So I'm taking a working. So here, working 1. So sales proceeds. As assigned 37 lease on a property for £110,000. £110,000 proceeds. £110,000. Then you need to deduct the cost of the lease. Now there you have to be a little careful. There's a special way to calculate the cost of the lease that you have disposed. Now for how much you have acquired the lease? 31,800. So the cost of the lease was 31,800. The cost of the lease was 31,800. However, that was the cost when the lease had a useful life of 46 years. The cost of the lease was 31,800. You acquired the lease for 31,800 when it had a lifespan of 46 years remaining. So to calculate then what happened? You used it for 9 years and then you decided to assign the lease, transfer the lease for 110,000 when it has a remaining lifespan of 37 years. So you acquired the lease for 31,800 when it had a useful life of 46 years, and then you used it for 9 years, and now you are selling the lease right for £110,000. £110,000 when it has a remaining lifespan of 37 years. So what you should do is you need to divide 31,800 by the percentage allocated for 46 years. It's like dividing 31,800 by 46 to find out the lease amount for 1 year. But here we don't divide it by 46 years. Instead, it should be divided by the relevant percentage allocated for 46 years. So cost is 31,800, but when it had a life of 46 years, so you divide it by 98.490. Now we want to find out the cost when it has a lifespan of 37 years. So you multiply it by 93.497. So let's get the answer. 31,800 divided by 98.490 multiplied by 93.497. Don't leave decimals, round it to the nearest whole number. So you get 30,000. 93,497. I'm sorry. 497. Yeah, 90.497. Yeah, 93.497. Yeah. Divided by 98.490 multiplied by 93,497. So that's correct. So the answer is 30,156. Let me see. 31,800, 98.490 multiplied by 93,497. There can be a small difference, but it doesn't matter. Yeah, 1 second. $31,800 say multiplied by 93,497 divided by, some of you have mentioned a different answer. Let me double check. Yeah, now you get 30,188. So yeah, 30,188. So when you do that, you get a chargeable gain of $79,812. Chargeable gain of 79,812. So assignment of the lease, there the chargeable gain is 79,812, but you have to be a little careful. This is an associated disposal. Assignment of the lease, as I explained previously, is an associated disposal. However, you cannot claim the full amount. You cannot claim the full amount under ER, Entrepreneur's Relief. Reason is you charge a rent of 40%. Therefore, from this chargeable gain, 40% does not qualify for ER. Only the balance 60% will qualify for ER, simply because you charge a rent equivalent to 40% of the market value. So you have to split this chargeable gain 60% to 40%. 60% to 40%. Okay, so here from 79,812, you need to take 60% here. There you get 47,887. And the balance from 79,812, 40% does not qualify for ER. Does not qualify for ER. So here I made a mistake. 1 second. 40%. 31,925. Okay, right. And then what are the other disposals that we are having? As sold 2 hectares of land on 1st of October 2019 for £30,000. For £30,000. Let's see, the sale of the 2 hectares of land should be a part disposal computation, but let's look at it. Sale of land, sale of land. So we will have to do a working here to get the answer, working number 2. So here, Ash purchased 8 acres of land. Ash purchased 8 acres of land for 27,400. So assume this is the land for 27,400. That is your cost. On 1st of June 2012, and then sold 6 hectares on the 1st of August 2015 for how much? 42,000 pounds. The remaining 2 hectares of land were worth 18,000 on the 1st of August 2015 on this date. And the part that you sold, we'll name it as A. The balance part, we will label it as B. Now, at this point, you need to do a part disposal computation. For part A, for 6 hectares, what is the chargeable gain? So on the 1st of August, this is not important, but I will show it. 1st of August 2015, that is during the tax year 2015-16. Sales proceeds. How much? 42,000 pounds. You have sold it for 42,000 pounds. Then you need to deduct the cost. You bought it for 27,400, and you multiply it by A, that is 42,000 pounds. Divided by A plus B, that is 42,000 plus B 18,000. Then you get the cost attributable to part A. Let's get that. From 27,400, what is the cost attributable to part A? So that answer multiplied by 42,000 pounds divided by 42,000 plus 18,000, how much is that? 60,000 pounds. You get 19,180. 19,180. Now, it's not important to calculate the chargeable gain, but since I started, I will calculate the chargeable gain as well. So there's a chargeable gain of 22,820 that arises from the disposal of part A. But the question is not about that. Now what has happened? During the tax year 2019-20, we have sold the remaining portion of the land. For how much have we sold it? I sold 2 hectares of land on the 1st of October 2019 for 30,000 pounds. So on 1st October 2019, you have sold the balance for 30,000 pounds. And what is the cost attributable to that? Less cost of purchase. You bought it for 27,400. And out of that, the cost attributable to part A was 19,180. 19,180. So the cost attributable to part B, that means the remaining 2 acres, 27,400 minus 19,180. You get 8,220. 8,200 and, sorry. 8,220 8,220, a minus figure. This results in a chargeable gain of 21,780. 21,780. So that does not qualify for ER. So that answer does not qualify for ER because it's an individual disposal of an asset. So it doesn't qualify for ER. So you record it in that column, 21,780. Then, as sold quoted shares and made a capital loss of 16,500. Now, in the current year, you have a capital loss. Now, listen very carefully. If you have a current year capital loss or even brought forward loss, and not only that, when you are using the annual exempt amount of 12,000 also, always use them against the gains not qualifying for ER. If you have a capital loss, maybe in the current year, maybe a brought forward amount, and when you are utilizing the annual exempt amount also, memorize it, always use it against the gains not qualifying for ER. As much as you can, try to bring down this gain. Try to bring down this gain as much as you can, because if you do not reduce this gain, since it does not qualify for ER, there's a higher possibility it will be taxed at the higher rate of 20%. But here we have no problem. This gain will anyway qualify for ER, so will be taxed at the rate of 10%, no matter the tax status of the individual. Therefore, if you have current year brought forward losses, annual exempt amount, first use it against the gains not qualifying for ER. So here, loss on quoted shares. Here, you don't have to do anything. The figure is given 16,500. Now, what we can do is we can calculate the chargeable gain. We can calculate the chargeable gain qualifying for ER and not qualifying for ER. So you can see, now here the gains not qualifying for ER will come down because of that 16,500. Okay, and now you can claim the annual exempt amount. Now you can claim the annual exempt amount. How much is that? 12,000 pounds. So you get the taxable gain here. Taxable gain. $282,887. Here, it will further come down because of the annual exempt amount, 25,205. And when you're calculating CGT liability, remember, you need to first calculate the CGT liability on the gains qualifying for ER. On top of that only, you need to calculate the CGT liability on the gains not qualifying for ER. So first on gains qualifying for ER, that is at the rate of 10%. At the rate of 10%. That means this 282,887 should be taxed at the rate of 10%. So you get 28,289. And then gains not qualifying. Gains not qualifying for ER. So obviously 25,205 should be taxed at the rate of 20% now. So 25,205 into 20%, So that is 5,041. So the total CGT liability is 33,330 is the CGT liability. So this is how you answer the question. First, you need to consider the gains qualifying for ER. On top of that only, you need to keep the gains not qualifying for ER when calculating the CGT liability. Therefore, most of the gains are predominantly occupied by the gains qualifying for ER taxed at the rate of 10%. But since the gains not qualifying for ER comes on top of that, they will be always taxed at the highest rate, which is 20%. Okay. Now, anyway, I'll explain. Here in this question, this person has a taxable income of 29,000 pounds. He has a taxable income of 29,000 pounds. 29,000 pounds. These are some basics. On top of that, you need to keep gains qualifying for ER. First, you keep the gains qualifying for ER. That is 282,887. Okay. So this is the taxable income. Taxable income. On top of that, gains qualifying for ER. You keep that in qualifying for ER. And that is subject to CGT at the rate of 10%. And then here, 29,000 plus 282,000, you get 311,887. On top of that, you keep the gains not qualifying for ER. Gains not qualifying for ER. So that is how much? 25,205. So it comes on top of this actually, on top of this. And the gains that falls within the basic rate band, the gains fall within the basic rate band, that is 37,500. Normally at the rate of 10%. Any gain which falls within the basic rate band, normally subject to tax at the rate of 10%. But here, it doesn't matter whether you are a basic rate or higher rate taxpayer, you have gains qualifying for ER. So up to 282,887 will be taxed at the rate of 10%. 10%. But the gain not qualifying for ER is somewhere here over and above 37,500. So this will be taxed at the rate of 20%. So this is how you do the computation. Right. So then a very limited time, but let me see the next question as well. I'll quickly try to answer the question. Yeah, let me see whether I can answer at least one part of this within the balance 10 minutes available, 10 to 13 minutes available. Yeah, now this is a 35 mark question or 25 mark. Yeah, it's 25 mark. So this is a section A type of question. So when it comes to a question like this, something that I have noticed, now 35 mark question, you know, you always prepare yourself for 35 mark question because you know bulk of the marks are coming from that. And it's worth spending time also because you at the end of the day get 35 marks. But the second question is the most trickiest question where most of the students find it difficult to answer and most of the students lose to maintain their focus on time management. Because it's a very tricky question. Now, if you're answering the 35 mark question, you know you get substantial marks. So you're ready to spend time and you should spend time on that. But this 25 mark question, you would see, now little while ago, we did a 20 mark question. Now that was a very simple, straightforward question with less information. There were not much information. Not much information. Therefore, based on the basic information, without spending much time to read, we were able to get the answer. But if you look at this question, they have only awarded extra 5 marks. A 20 mark question, and here 25 marks, only extra 5 marks. But for that 5 mark, extra 5 mark, they have included a lengthy question. It's a lengthy question. Therefore, you have to be very careful when you answer this 25 mark question. You should not spend much time answering this question. First, you should answer that 35 mark because you can't afford to lose that question actually. But then it's better to answer the 220 mark question because those questions are normally not complicated like part B. So then you know you have scored 40 marks from there and then you can answer 25 marks. So don't spend too much time than allocated to answer this question. So anyway, I will try to answer the theory question that you have been given. The following marks are available. Carry out the work required as requested in the email from your manager. A, capital gains tax, 8 marks. B, inheritance tax. So bulk of the marks are allocated, 17 marks actually from inheritance tax. Only 8 marks are allocated for capital gains tax. So let me try to answer that part. What do they want us to answer from capital gains tax? You can actually answer part by part without reading the whole question. So it's a skill that you need to develop by answering and practicing more and more questions. That's the whole purpose of having this session, practice to pass. So you need to practice. You don't have any other choice there. An explanation with supporting calculations of the UK capital gains tax liability in respect of the disposals made by Brad whilst living in the country of Kyrenia. Your explanation should include the precise reason for Brad being regarded as only temporarily non-UK resident and a statement of when the tax will be payable. So this question is actually about a concept called temporarily UK resident. Temporarily UK resident. Let me explain the concept. Temporarily UK resident means, as I mentioned at the beginning, CGT is a tax charged only on UK resident individuals. Only a UK resident individual is subject to CGT. If a non-UK resident individual sells something, that gain is not subject to UK CGT. Therefore, sometimes people may try to misuse this rule to avoid their CGT liability. In other words, you may try to sell your assets while you are absent from UK. Because if you are absent from UK for a substantial time period, you may be treated as a non-UK resident individual. So while you are abroad, you may sell the assets at a gain, and the gain will be not subject to UK tax because you are not a UK resident person. However, HMRC will not allow you to avoid taxes by using methods like that. Therefore, there is a principle called temporarily non-UK resident. Temporarily non-UK resident. Temporarily non-UK resident. So here you can see the words are very clear. Temporarily non-UK resident. That means if you were absent from the country, if you were absent from UK only for a shorter period, a temporary period of 5 years. So if you are absent from UK for a period of less than 5 years, that means within 5 years you have returned to UK, and if you have sold an asset at a gain while you were absent from the UK, though you were not a UK resident, you will be subject to CGT once you return to the country. So it's like this. Let me explain it. So it's a situation like this. It's a situation like this. 1, 2, 3, 4, 5. Say you leave the country, but you return within 5 years. You return to UK within 5 years. You return to UK within 5 years. Within 5 years. In that case, while you were absent from UK, less than 5 years, but while you were absent from UK, if you have disposed an asset, at a gain, it will become chargeable. The moment you return to your country. Not at the time of disposal, but within 5 years, once you return to the country, the moment you return to the country, you will have to pay CGT on such gains, though you were non-UK resident during that time period. However, you have to be little careful here. There can be 3 types of assets. One, assets bought before leaving and sold after leaving. That means there's an asset that you have bought before you left the country, and then you sold it while you were absent from the UK, then that asset will become chargeable. That asset will become chargeable once you return to the country. There's another situation, assets bought and sold after leaving the country. After leaving the country. That means the asset was not there when you left the country. You bought it while you were absent from UK and sold it also while you were absent from UK. Now that is not covered by temporarily UK resident rules. Here we intend to avoid situations where individual buys the asset, individual has bought the asset while they were in the UK, and then they leave the country and sell the asset as a non-UK resident person to avoid taxes. So HMRC will not allow you to do that under anti-tax avoidance rules. But if you have bought the asset after leaving the country, so you have bought it while you were not a UK resident person and sold it also while you were not a UK resident person, then it will not become chargeable. Then it will not become chargeable. Then the third situation is assets bought and sold before leaving the country. Of course, this is not covered by temporarily non-UK resident rules, but this is a situation where you have bought and sold the asset. Bought and sold the asset before you left the country, then it will become chargeable under normal rules. Okay. Now what we have to do is let's look at the assets. Now read the question and we'll quickly answer. Brad is 70 years old. He's married to Laura, and they have a daughter, Dani, who is 38 years old. Brad had lived in the UK for the whole of his life until he moved with his wife to the country of Kenya on the 1st of January 2017. So he left the country on the 1st of January 2017. He returned to live permanently in the UK on 30th April 2030. 30th April 2020. So he left the country on the 1st of January 2017 and came back. Within a period of 5 years, within 5 years. Okay? He returned to live permanently whilst living in Kenya. Whilst living in Kenya during this time period, Brad was non-UK resident and he is now resident in the UK. He has always been domiciled in the United Kingdom. Brad has significant investment income and has been a higher rate taxpayer for many years. Whilst living in the country of Kenya, Brad sold various assets as set out below. He has not made any other disposal since 5th of April 2016. Now I will explain quoted shares. What matters is, when did he purchase? 1st of October 2015. 1st of October 2015. When did he sell them? 1st December 2016. He sold them 1st December 2016. So in this situation, quoted shares, bought and sold before leaving the country. So 1st December 2016. So there you get a sales proceeds of 18,900 and a cost of 14,000 pounds. So there is a chargeable gain of 18,900 minus 14,000, 4,900, and this will be taxed in the year of disposal, that is 2016-17. Because this is not covered by this is not covered by temporarily non-UK resident rules. He bought it and sold it while he was in the United Kingdom as a UK resident individual, therefore will be subject to CGT on this 4,900. This is the sales proceeds, this is the cost. This is the date of disposal. Then painting. There, bought 1st of June 2019, bought 1st of March 2015. Bought 1st of March 2015, that is before leaving the country, and sold it while he was not in the country. This will be covered by temporarily non-UK resident rules. This will be covered by temporarily non-UK resident rules. Because sold on the 1st June 2019. Bought before leaving the country, therefore 36,000 minus 36,000 minus 15,000 pounds. Now here, remember, this will be covered, this falls within the rules of temporary non-UK resident, because you bought the asset before you left the country and sold it while you were absent from UK. Therefore, even though this gain arose when you were not a UK resident individual, since you returned within a period of 5 years, on your return on the 30th of April 2020, this 21,000 will become chargeable. You sold it on the 1st of June 2019, but at that point, this is not going to be chargeable. It will become chargeable on his return on the 30th April 2020. That means during the tax year 2020-21. Actually, the disposal took place during the tax year 2019-20, but it will become chargeable only on his return to UK on the 30th April 2020, which falls into the tax year 2020-21. You understand that? So then, antique bed. Antique bed. Bought 1st of April 2020. 1st of February 2017. For 8,500. 8,500. And then sold it for 9,400. But when did you sell it? 1st March 2020. Sold it while you were abroad, bought it also while you were abroad. 1st of May 2017. 1st of May 2017, you bought it after leaving the country, sold it while you were absent from UK, not subject to UK, no CGT. Because Both happened while you were not a UK resident person. You bought it while you were not a UK resident person, sold it also while you were not a UK resident person. In that case, this will not be subject to CGT. And this is where you have to be mindful when you're answering a question. Here, you should not waste your time to analyze this because it is a motor car. Quoted shares, paintings, antique beds, all are chargeable assets. But a motor car, it doesn't matter whether you were temporarily UK resident or not. Motor cars are never subject to CGT. It is an exempt asset from CGT. Exempt asset from CGT. Therefore, you do not have to do any computation in this situation. So the only amount that is subject to uh, temporarily non-UK resident rules, temporarily non-UK resident rules are the paintings, So this 21,000 will become chargeable in the tax year 2020-21. From this, you can deduct the annual exempt amount, and on the balance, you can pay CGT. So this is the meaning of temporarily non-UK resident. So as I mentioned, go through your the textbook, go through whatever the tubes that are available from both inheritance tax and CGT, complete both areas, and then start attempting questions within the time period available. So let's stop at this point, and I will mention my number again, my WhatsApp number, because some people requested for it. So I will try to answer within the time available. So now I have sent it. So if you have any questions, you can WhatsApp your questions to me. So I will try to answer. May not be answer immediately, but I will anyhow answer. So we'll stop at this point, and tomorrow, during tomorrow's session, I'm going to discuss mainly about the aspects of employment income. So let's meet up tomorrow then at the same time. Until then, take care. Good night.